Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In our previous two lessons, we have learned about ROA and solvency ratios. In this class, we'll look at how to use return on equity to judge the profitability of a company. First, let's take a look at the concept of shareholders' equity. Looking at an example, suppose you want to start a business. You have $1 million in your bank account, but you realize that won't be enough to grow your business in the future, so you decide to borrow some money from your buddy Jack. After some negotiation, you manage to persuade him. Jack invests $500,000 in your company and becomes your partner. Now you are the biggest shareholder, and he's now the second biggest shareholder. Following 1 year of operation, the company has $2 million left after deducting costs, expenses, and taxes. These $2 million is what is called shareholders' equity, also known as the net asset value of the company. Once we know what shareholders' equity is, return on equity is easy to understand. Return on equity, or ROE, is simply the money that you and Jack will make back on your investment. ROE is an important indicator for all investors. Understanding ROE will let you identify profitable companies. ROE equals net income divided by shareholders' equity. We can see from the formula that the amount of shareholders' equity directly impacts ROE. So, we have to first understand the elements of shareholders' equity in order to better understand its relationship to ROE. Now, to help you identify profitable companies, let's take a look at the specific types of shareholders' equity. These include common stock, preferred stock, capital reserve, and treasury stock. First, let's take a look at the common stock. Common stock is the most common form of stocks. As most of you know, a company raises money from the public through the issuance of stock and bonds. A bond is like an IOU that will have to be repaid, with interest, at some point in the future. On the other hand, issuing common stock to raise money is like asking an investor to join your company and to share in its success as well as in its failures. Investor will only make money if the company makes a good profit. The company has no obligation to return investors' initial investment at a future date. Second, there is preferred stock. Issuing preferred stock is also a way for a company to raise money. However, it is different from common stock. The first difference is, holders of preferred stock have no voting power. Common stock represents ownership of company and so gives its holders the power to elect the company's board of directors, a right not enjoyed by holders of preferred stock. The second difference is that preferred stock pays a fixed dividend, which is not affected by market volatility. As with bonds, preferred stock has a fixed dividend that is not affected by stock price or earnings. Payment of common stock dividends, however, depends on the profitability of a company and is not guaranteed. This also means that dividend payments to preferred shareholders are not affected by the ups and downs of the market. The third difference is that when a company files for bankruptcy, preferred shareholders will receive compensation before the holders of common stock. In the case of liquidation due to bankruptcy, the order of priority of payment is bondholders greater than preferred shareholders greater than common shareholders. Listed companies generally see issuing preferred stock as an expensive form of financing. So good companies generally don't do it. You'll find that companies with a sustainable competitive edge usually haven't issued much preferred stock. The third item is capital reserve. Once you understand common and preferred stock, it's easy to understand capital reserve. I'll use your buddy Jack as an example again. Suppose that Jack's company issued preferred stock with a face value of $20, which is then sold to the public at $50. As a result, $20 will be booked into the preferred stock account, and the surplus of $30 will be booked into the capital reserve account. The same rule applies to common stock. Suppose that Jack's company issues common stock with a face value of $100, which is then sold to the public at $120. Consequently, $100 will be booked into the common stock account, and the surplus of $20 will be booked into the capital reserve account. Moreover, if Jack's company is engaged in advanced technology and receive funding through government grants, these funds will be booked into the capital reserve accounts as well. Finally, let's take a look at treasury stock. Treasury stock is simply stock that a company takes out of circulation by repurchasing it and keeping it in inventory. Why would a company do that, you may ask? Let me explain. Let's say that Jack's company is now listed and doing well. Unfortunately, the stock market is plunging and the share price of the company is being dragged down with it. The shareholders, however, maintain their confidence, and the board votes unanimously to buy back 5 million shares. Investors see this move as a sign of management's confidence in the company, as the company is buying its shares with its own money. As expected, this move will boost investor sentiment and cause the share price to rise. Now, where do the repurchased shares go? If cancelled, these shares cease to exist. However, if they're held for possible reinsurance in the future, the repurchased shares are classified as treasury stock. It's important to note here that the presence of treasury stock on the company's balance sheet indicates that it is financially strong and competitive enough to have had enough cash on hand to buy back its own stock. I hope you're clear now on the 4 categories that make up shareholders' equity. Simply put, shareholders invest a sum of money into a company which is called shareholders' equity. The company uses this money to operate its business, and the net income earned from these operations is the net return for shareholders. So analysts calculate the company's ROE to determine whether the company is making money and is worth investing in. ROE is arrived at by dividing net income by shareholders' equity. It demonstrates the company's ability to earn a profit using its own funds. If Jack's company, after a year of operation, makes $150,000 in net income and has $1 million in shareholders' equity, then its ROE is 15%. A high ROE demonstrates strong earning power. We should always look for strong companies with high ROE that would generate consistently healthy returns for us. ROE is one of Buffett's favorite indicators. He looks for companies with an ROE of at least 15%. Did you know that Apple has maintained an average annual ROE of 45.5% over the past decade? If you had bought 10,000 shares of Apple in November of 2011, it would have cost you $11,780. The value of those same shares today will be $147,870. That would mean a cumulative return of 1,250% over 10 years. If you find and invest in a company with ROE consistently above 15% and hold on to it for the long term, you will have a good chance of seeing a healthy return in the future. Now you know why ROE matters so much to Warren Buffett. Let's summarize. In this session, we learned about common stock, preferred stock, capital reserve, and treasury stock, as well as ROE, an important indicator for Warren Buffett. Investors should include companies with ROE consistently above 15% on their watch lists. And that wraps up our lessons on the balance sheet. Congratulations! You've taken another step forward on the road to investing like a pro. So far, we've learned how to calculate a company's return on assets and how to access its solvency and profitability. In the next class, we'll use Apple's 2020 balance sheet as a case study to apply what we've learned. See you next time!